Hi, everyone. Thank you for joining today's webinar, Behavioral Arbitrage, Design Strategies that Time Market Mistakes. Today's speaker is Cheng Peng. Cheng is currently a software engineer at Betterment, the largest independent online financial advisor. Betterment manages more than $10 billion in assets for 280,000 customers. Prior to Betterment, Cheng worked across multiple industries, including AIG, Blackberry, and Textnow, as an analyst, software engineer, and startup founder. His passion for finance and technology drives his independent research. Thanks, Cheng.
Thanks for the kind introduction. Thank you, everyone, for coming. Today, I'll be talking about behavioral arbitrage and basically how to design strategies that time market mistakes. But before we start, I want to talk about the motivation behind this topic. When developing systematic strategies, one of the biggest issues is finding economic intent, economic hypothesis in your strategy so that you can continue trading them. And you can do that in many ways. You could read research papers, you could read books, you read quant blogs. However, there are an infinite number of ideas, and it can be really hard to find ones that actually work. And most of them, unfortunately, after you try to build a systematic strategy around them, tend to not work. So today, I hope to give you a framework to think about how to develop systematic strategies with economic intent based on behavioral biases and how you can take advantage of that in your development and systematic trading. So to start, there's a disclaimer that everything here is not investment advice, it's for informational purposes only, and everything here is my own opinion and not associated with anybody else. And today I'll go through a couple things. One, I'll talk about the framework for how to time market strategies, how to time market mistakes, and give an example with earnings, how you can use recency bias to actually take advantage of mispricing. Second, I'll also talk about the commentary between relative and intrinsic value and how we can use that in creating a post-earnings strategies regarding inefficiency. So first, what is behavioral arbitrage? In essence, it's just taking advantage of mistakes that derive from behavioral biases. And in general, I like to look at it in two types. One is cognitive biases. These biases are things that we might not be aware of, but things that we do just innately. And here I have two examples. One is confirmation bias. This is where people tend to confirm things they already know and ignore a lot of the material that's out there. Secondly, recency bias. People also tend to look at the most recent occurrence of a thing and weight them much heavier than they should be. And that's a bias that everyone does unintentionally. Another bias is emotional bias. These biases are things that people are aware of, but might be really, really hard to correct. And one of the most prominent ones is loss aversion. People are generally afraid of losing than they are of gaining, even if it's the exact same percentage, or even if you had a 6% gain over a 5% loss. And this is rampant across many investment information. Overconfidence is another one, where a lot of retail traders might have overconfidence in their one strategy and put all their capital in it without realizing that they're actually wrong. So how is this useful? The most obvious use case is protective, to protect yourself from these biases. And that can be done from reading more books, understanding more of your blind spots, understanding your situations, and making things more systematic. But personally, I also want to take it another level to actually do it in a more aggressive way and how we can use it to benefit our trading strategies. And this is an example. This is not an actual stock or anything. This is just a representation of some sort of asset. The red line is the price, and the dotted gray line is the mean or maybe the true intrinsic value, whatever you want to call it. And you see in this red graph that there's a lot of annotations that are just there. And these annotations may or may not be accurate, but it just goes to describe the different types of market emotions and how human behavior, how the mobs really affect the price of something, regardless of how much it's actually worth. This may or may not look similar to Bitcoin or anything else out there, but just give you an idea of how this is useful. And why is it useful? Well, you can't just short this. You can't just say, I'm going to short this maybe during the first sell-off or an awareness phase, because when the bubble does pop, generally there's a huge increase in the price, and they'll actually short squeeze you. So when you think about things behaviorally, it'll give you a better idea of how to time the market and approximately when you should start shorting or when you should start entering position, and also when you should exit a position. And I want to break it down to a three-step process. First, we want to understand what the market is currently thinking. Because only after we understand what the market is thinking can we actually understand, well, why could the market be wrong? And after understanding why the market is wrong, then we'll have an idea of, well, how wrong is the market? What can we do to make our strategy take advantage of this incorrectness, of this bias, or whatever that may be? And it's really a simple three-step process, but obviously it's not easy. And the biggest reason why it's not necessarily easy is because in every one of these steps, you can interpret it any different way. So like, what does the market think? You can use price, you can use sentiment. There's lots of ways to do this. So I'll go through one of those ways that I look at it. And this might not be the most accurate way. There might be different ways of doing this. But let's just say the market's view is dependent on the current price. And the current price basically says how much this asset is worth, what's everyone already pricing it as. And prices come from basically bid-ask transactions, orders that get put into the market from humans or other people on the other side of the market. So someone is making a decision to actually decide, well, how much will I pay for this? How much will I sell for this? What is the price for this? And human decisions ultimately are influenced by human behavior. It's not a direct cause, but it's influenced by human behavior, personality, a lot of things. And human behavior is also influenced by information. So you can imagine the type of information that we ingest, that we read, that we know of, affects our behavior because we interpret the information in different ways. And ultimately, that makes a difference in our actual decision when we buy a stock, sell a stock, or do anything of that sort. And so I really want to focus on these two spots. I want to focus on how information could be interpreted in a biased way, which leads to bad human behavior. And I want to also focus on how bad human behavior might be biased in ways that influence our decisions. And I like to look at it in a sense where we have an input, a model, and sort of an output. The input here could be any sort of information. It could be CNBC News, it could be Twitter, it could be the new market tick price. And the model could be different variations of human behavior. For example, recency bias, confirmation bias, loss aversion, whatever behavior we believe is happening in the market right now. And these ultimately have some sort of output, which is directly testable given on the current price, since ultimately this affects the price in the markets. So a couple of examples I want to give. For example, let's say the new information is that SPY has a flash crash. And this new information is interpreted by the market, by people who are looking at the market. And the first thing people will have if they have a position in SPY is loss aversion. So why would they have loss aversion? That's because if you see something go down, the first thing you think of is, what if it goes down more? And although things go down, there's an equal chance it'll go back up, a lot of times the market or people who hold SPY will actually sell it off. Another example is social media hype. Let's say there's a lot of social media around a certain stock, a certain asset, and that's getting shown everywhere. Your friends is retweeting, it's on CNBC, everyone knows about it. And when everyone knows about it, and if there's any kind of bullish aspect to it, then that might lead to bad human behavior where you might look at it and say, well, everyone else is buying it, so I should too. And finally, the last example that will be related to the application later is how earnings surprise or beating last earnings expectations might lead to a bit of a recency bias. Because when you're looking at the next earnings, you look at a company and you say, hey, I beat the last earnings, I'll beat the next one, maybe. And then there might be some recency bias because the last earnings doesn't necessarily mean the next earnings is going to be any different. In fact, you might want to have a projection, you might have to look at the fundamentals. There's a lot more information that should be accounted for. And this is what I'm talking about. Information leads to different kinds of behavior, which leads to different decisions, and those decisions actually create more information. So we can see how this internal loop goes on and on and on. And to make things more complicated, it's not like the new information replaces the old information. No, in fact, new information actually only affects the old information, and it could be merged, it could be changed. And that information, again, gets interpreted, again, with a new behavior and new decisions. So more specifically, this is a diagram I want to show you. We see the difference between old behavior and new behavior is what we're looking for, because that difference will lead to difference in pricing. So that means we have to look at the inputs very carefully, because the old information directly affects how behavior is going to change previously versus in the new world. And in the new world, we want to make sure that we can try to model the new world as best as we can, and then have an understanding of what the gap is between a new behavior and an old behavior. Because after understanding kind of what the gap looks like, can we actually start increasing or optimizing our strategy in that way? So more formally, as discussed earlier, it's just the absolute difference between the old behavior and the new behavior. And the old behavior is generally based off of biases that the market already has about this stock or this asset. But new behavior is a bit different. In fact, new behavior is dependent on two different things. One is a sensitivity of the new information. So different kinds of information gets treated differently. For example, an earnings surprise, the number, EPS, whatever it could be, is very sensitive. The minute that number comes out, the number is very different, it's absolutely different, then people start reacting to it. Versus maybe Twitter, maybe someone random tweets about a certain company, and no one really cares about it. Obviously, if President Trump is tweeting about it, that's different. So that's sensitivity. And secondly is dispersion of new information. So just because it's new information, we have to understand how fast does it travel, right? If it's information in a 10K, maybe it's a paragraph in a 10K, well, that's not going to move very quickly. People are not going to be reading this one paragraph in a 10K and then spreading it everywhere very quickly. Versus if something gets put on CNBC, it gets put on Twitter, it gets put on a lot of news outlets, then suddenly this new information is being dispersed very quickly. And these two things, both sensitivity and dispersion, will directly affect how volatile a new behavior is going to be. So let's start with an application this time. And the same three-step process. What is the market thinking about the next earnings? Why is the market wrong about the next earnings? And how wrong is the market about the next earnings? So similarly to what we had before, let's just assume that the current price is a good proxy to understand the market's current view. Unfortunately, price is not directly comparable, so we have to normalize with something. And I decided to pick weekly returns starting one day before earnings. This isn't necessarily accurate. We can do different ways of interpreting the market information. We can use a monthly return, we can use intraday, we can use a momentum indicator. But for general purposes, the weekly returns are short enough to understand what the market is currently thinking, and it's a very simple one we can use in this example. So given this, I want to create two portfolios. One, a bunch of stocks, the top 25% of the universe with the highest weekly returns, and two, the bottom 25% of the universe ranked by weekly returns with the lowest weekly returns. And the question now is, well, which portfolio should we go long or short? The most obvious answer is, well, you want to buy low, sell high. So you go long the low returns, go short the high returns. However, that's not necessarily true, right? Because we're just interpreting the market's current view. That doesn't mean that's going to happen in the future. We don't know if the high weekly returns will go higher or if the low weekly returns will go lower. I mean, if there's a momentum play here, then going against the market actually hurts you. So then it's really important here then to understand, well, why is the market wrong? Because only understanding why the market is wrong can we confidently take a different view. So for this example where I want to use recency bias, I want to look at the last earnings. When the market looks at the current stock's earnings, if a stock beats last earnings, it's possible that the market assumes, based on recency bias, that they're going to beat the next earnings again. And similarly, if the stock has missed the last earnings, it's possible the market will price in an assumption that the stock will miss the next earnings and short the next earnings. So only based off of this can we make an assumption to say, okay, since the market is having a momentum play here, we want to go the other way because the market's momentum play is actually wrong according to the human bias that we're looking at. Therefore, we want to go long the stocks with low weekly returns and go short the stocks with high weekly returns. And we can see here is the weekly returns ranked by quantile right before earnings. And we see how, and generally in a lower quantile, weekly returns tend to go up, and in the higher quantile, weekly returns tend to go down. And here's more of an event study to kind of visualize what's actually happening here. I want to focus on two lines, the red line, the quantile 1, and a blue line, the quantile 4. So we see how right after earnings, actually, it's interesting how the first quantile actually goes above the fourth quantile, and then eventually evens out and it becomes more efficient. So in this case, this means we can actually go long the first quantile before earnings, go short the fourth quantile before earnings, and then actually harvest a bit of arbitrage in day 2. So in addition, well, since our bias is going to be about earnings surprises, we want to take that into account. So here we have two portfolios where we divide all the companies based off of their earnings surprise, and we create portfolios with one, the highest surprise, top 25%, and secondly, the lowest surprise, the bottom 25%. Based off of our initial model of the recency bias and why we think the market is wrong, this means we want to go long the stocks with the lowest earnings surprise and then go short the stocks with the highest earnings surprise. So now we end up with 4 portfolios or 4 different things we look at. And we want to go long low returns, low earnings surprise, and go short high returns and high earnings surprise. This is the earnings surprise ranked by quantile. And we can see in the first quantile and the fourth quantile that there's a huge mean reversion. That earnings surprise is actually inverts. So it's interesting how in the first quantile, while we have the lowest earnings surprise, the stocks there tend to go up very quickly. And similarly, in the fourth quantile with the most recent highest earnings surprise, it also inverts very quickly. And in detail in this more event study, we can see how if we went long the first quantile and short the fourth quantile, which basically means going long the stocks with least earnings surprise while going short the stocks with the highest earnings surprise, we'll actually end up with a bit of profit, and the spread actually gets a bit wider. Now, the next step, I want to combine the weekly returns and also the last earnings surprises. And we can do this easily by just using a cross-section. So we rank the returns, we rank the surprises, and then we combine them, and then we finally take, we go long the bottom 25% of that, and we go short the top 25% of that. So we have our portfolio, everything is nice. And we also want to ask the question, well, when should we exit this trade? So this is the combined version where we take weekly rankings, take the rankings of the earnings surprise, put them together, and this is what we get. So we see actually a more consistent spread from day 2, 3, and 4, and 5, but it's not exactly clear when we should exit this position because although it looks like day 3 and 4 might give us a bit more returns, it's not very significant. And the question is like, well, how long do we hold this? And here's where I want to come back to this gap, this behavioral gap, where we have old information that's feeding our old behavior, and that old behavior is making decisions, and new information is causing new behavior and new decisions. So we look at this and we say, well, in the old behavior, we had the market's view, we know the recency bias, and we have a new behavior, but that's completely dependent on new information. So end of the day, we want to go back, okay, so what is information? What information are we looking at again? And here's where I come back to the gap is the difference between old behavior and new behavior, but the new behavior is dependent on 2 things again, and that's a sensitivity and dispersion. So in this example with earnings surprise, we can assume that the sensitivity is actually relatively large. It's not like legal news, but it's relatively large because when a company misses or beats earnings, that is actually meaningful. Analysts, investors are already taking action immediately. For dispersion, how fast does this news travel? It also travels relatively fast. Why? Because news outlets actually care, right? For example, Netflix misses earnings or misses projections. Whichever company misses something or beats something, people want to talk about it. So that gets spread news relatively quickly. So based off of this, we can make an assumption that our position should be relatively quick. We should exit relatively quickly. And here with the cross-section of the portfolio, this new portfolio, we want to exit this trade probably between intraday and maybe 1 day at most. And for simplicity purposes, I want to stick with 1 day just because exiting positions intraday becomes very difficult especially when we're talking about very volatile earnings and a lot of volume is not there sometimes. And finally, I want to kind of talk about the gap, maybe how we can increase the gap. How does the gap really work, right? So for the old behavior, our assumption was, well, there's some recency bias. People aren't really going to change their beliefs. They're going to go momentum. And with the new behavior, well, new behavior now is going to be idiosyncratic correction, because the new information actually corrects the previous biases, and now the market's going like, we have to fix this somehow. We have to price it differently. And in our case, building a strategy around this, we want to actually increase the gap as large as we can. So we want to maximize this idiosyncratic correction. And there's lots of ways to do this. And for what I picked, I thought, well, if we just filter the earnings estimates with higher standard deviation, that means every stock we're looking at actually has unstable estimates, and therefore are less reliable, and therefore there's a higher probability that there's going to be idiosyncratic correction. And this works out actually pretty well. So this is the same event study ranked with weekly returns and earnings surprise. But the difference is there's an extra filter on it to kind of exaggerate idiosyncratic correctness based off of the estimates of volatility. And it looks like from the old profits in the black bar, that's a lot smaller than new profits in a green bar. So we can more or less assume that this is actually really, really effective. So kind of putting it all together here again, we understand, well, what was the market thinking? The market, we use weekly returns to estimate what the market is currently thinking, the market view. And why is the market wrong? Well, we used recency bias from the last earnings surprise. And the last earnings surprise helped us understand, we think the market is having this low bias here that we want to correct. And next, well, how wrong is the market? And that can be determined directly by how sensitive the information is and how the idiosyncratic correction is actually large enough to fill the behavioral gap that we can actually take advantage of it. And this is some backtest results. This is not necessarily meaningful in any sort of way. This is to give you an idea of like, this strategy actually has potential. This is definitely not the final version. Would not recommend just trading this live. And I also want to note that there's no slippage here, so a lot of optimization that can be done to fix this. But from my first pass, it generally looks pretty good. And we can see the in-sample, out-sample results are relatively consistent. Obviously, it's a bit low, but that's expected given alpha decay and the market environments. And this part I want to touch on specifically. There's about 6,088 events in this period. And I think it's really important to point this out because a lot of times when applying filters, you could end up with very profitable strategies, but very few events. And at that point, you have to ask yourself, is it overfitting? Is it real? And the question there becomes really hard to answer. So generally, I think 6,000 or so events over 7 years, that's about maybe 800 events a year. So given that number of events, I think that's a reasonable assumption to make that the strategy is relatively reliable, but obviously this is something that a lot of people overlook. So next, I want to kind of go into the commentary between relative value versus an intrinsic valuation. And this is very useful later on when we talk about how to create a strategy around post-earnings efficiencies. For intrinsic value, this is an example. Obviously, intrinsic value can be done in different ways, but here I look at it as reinvestment, less cost of capital, less risk. So how much is a company reinvesting with their cash flow? How much is the cost for them to get that capital? And how much risk is there directly to this company? You do some discounted cash flow projected over the future, and you have an idea of like, well, how much is a company worth? With relative value, it's a bit different. We don't really care about that. We're looking at just ratios generally and things that are very comparable. And here, the example is, well, maybe this is P ratio compared to sector average, and that gives us an idea of how expensive a company is based on their earnings. However, the question here is, well, which one is better? And there's no answer to that because it depends how you use them. Both of them have their merits, and they're used in different ways for different purposes. And I want to explain this from a behavioral lens to give you an idea of what do I mean. So with the same diagram, I want to look at the information. Here I replaced the old information and new information with old fundamentals and new fundamentals. So these fundamentals are just going to be released at certain points in time, but it's really how it gets interpreted in the behavioral aspect. So intrinsic valuation, we think about you only make intrinsic valuation when you're looking at a company really long term. You never make an intrinsic valuation of the company for years if you're only tending to trade for a week. So the market, or the section of the market that's actually using the information in this intrinsic value way, actually has a very, very slow time frame. And similar to relative value, well, in relative value, the fundamental releases directly affect the ratios. And in relative value, the market immediately reacts to relative ratios within a few days or immediately. So that gives you an idea of how intrinsic value and relative value can't really be compared in this way. And generally what I mean is intrinsic value, stocks are valued today, but the expectation is really for years. So really the sensitivity of it, it's very different. And for relative value, well, we price them today, but we don't really expect any differences until tomorrow. We're only just pricing it right now. And this is pretty useful when we talk about trying to create a strategy for earnings efficiency. So first, I want to go through, well, again, the same kind of framework. What does the market think? And we want to do it in the frames of post-earnings. So unlike pre-earnings, the market is not speculating nearly as much as it was before. Now the market is saying, we have all this information, how are we going to accumulate that into some sort of price? How are we going to actually price this asset? And the key here is the difference in earnings expectation. That is what is driving the price difference, because the expectation is going to cause the market to adjust the prices based off of what mistakes was made beforehand with what's going to happen right now. So how I look at it is we could use the new market view with P ratio. P ratio is a very approximate view of understanding why what the market is currently thinking. And again, we create two portfolios. One, stocks with the highest P ratio, and two, stocks with the lowest P ratio, top 25%, bottom 25%. And we have the same question, well, do we go long or short? Do we want to go long high P ratio, or do you want to go short high P ratio? That's a question I want to answer next. And that's why this is really important. We'll have to always understand why the market is wrong, because it's very possible that when you're going short high P ratio because it's too expensive, that the stock keeps going up and you actually lose a lot of money. So the context here is we want to understand that multiple earnings announcements actually lead to information overload. Basically, the market participants or the market can't make all those adjustments immediately because there's way too much information and not enough liquidity to actually meet those requirements. And this will actually end up leading to inefficient prices that could be taken advantage of. So based off of this, we can make the assumption that we want to go long low P ratio and go short high P ratio. And the main reason for this is because we want to make sure we're taking advantage of the bad valuation. So now that we know that, we want to understand, well, how wrong is the market? Because now that we understand why the market is wrong, we want to bring it a step further. We want to take advantage, we want to optimize our strategy to make as much money as we can. And to understand that, we have to understand how earnings works. Well, volatile earnings lead to more attention, right? When there's a huge earnings miss, a huge earnings beat, people are more aware of it. And that means there's more market efficiency because more people are trading, more people know about it. So for us, since we're taking advantage of misevaluation, we want to do the opposite. We don't want earnings that are volatile because that attracts more attention. So we want to use absolute earnings surprise as a proxy for attention and then filter out the earnings to only include those with the least earnings surprise both ways, whether it's a beat or a miss. And this could be counterintuitive because, well, if there's no earnings surprise, how is there a chance for misaligned valuation? And the key here is that that's not necessarily true. It's really how the market reacts to it. So this is the quantiles for a PE ratio. And this is including with the filter. And we can see how in the first quantile, it's steadily going up, while in the fourth quantile is relatively negative. So going short, high P ratio and going long low P ratio is actually advantageous for our situation. And here we see that post earnings, we can see up to 4 and 5 days, there's actually a good profit opportunity that spreads itself. You can't see it here, but past 5 or 6 days, the spread actually starts to slowly close So about 4 or 5 days is the perfect optimal place to actually exit the position here. And here's another back test to kind of demonstrate how well the strategy is done historically. And again, there's no slippage here, but looking at it, looks pretty consistent, above 1 sharp. Similarly here, it looks like the outer sample looks pretty good. It's more or less consistent with what we expect. In sample is actually a bit better here, actually. And finally, we look at number of events. Well, there's 6,081 events, and similar to what we had before, this is a good thing, because this gives us more confidence that our filter and our strategy actually makes sense. It's not just, you know, a lot of overfitting that ended up happening to have a good performance. So I want to go through a bit closing remarks. I want to talk about the 3-step process yet again. Basically, we want to look at how what the market is thinking, understand why the market could be wrong, and after understanding why the market could be wrong, then we can actually understand how we can optimize our strategy to maximize our profits based off of the behavioral gap that we discovered. And again, this is simple but not easy. And I hope that generally this presentation gives you a better idea of how to actually look at markets and how to actually develop strategies with this in mind, how to create economic intent in our systematic strategies. And if there's anything that I want you to take away from this, it's really just this one diagram. There's one diagram where the old information leads to old behavior, that's old decisions, and new information sparks new behavior. And the difference between new behavior and old behavior is what the opportunity you want to capture. And thank you.
All right, guys, we're going to move on to the question and answer part of the webinar right now. So in the questions tab on your control panel, you can go ahead and submit your question. Cheng will get to as many as he can in this session. And if we don't get to your question because we ran out of time, you can still email it to us at events@quantopian.com. So Cheng, you can go ahead and start with the questions that we have had come in already.
Cool. So first question here, how does one know what the market is thinking? There's really no way to know what the market is actually thinking, but one of the reasons why I use weekly returns or some sort of metric is we want to interpret as much as we can to understand approximately what the market could be thinking. And unfortunately, there's obviously no straight answer to this, but I think the more you play with it, the more you think about how the market reacts, we can understand what the market is thinking based off of the current prices, sentiment, and a lot of things like that. Second question, says here, do we recreate low returns and high returns every week? Yes. All the returns are recreated on a daily basis. So whenever we look at returns 1 day before earnings, that number is actually 5 days before 1 day before earnings. What source are you using for earnings estimates? I'm using Zach Surprises, and Zach Surprises is already on Quantopian. It's generally free, and that's what I'm using right now to determine what the earning estimates are. So how does the strategy work in bear markets? It depends how you define bear markets. When I tested it in 2008 to 2011, it obviously didn't perform nearly as well because the markets only had really one view. But it was negative, so that gives you an idea of like how it performed in bear markets. So here, if you're using reinvestment as part of intrinsic value metric, why don't you use PEG for an extrinsic? PE doesn't account for growth, which is why companies reinvest. I didn't play around too much with it, but you could definitely try PEG. Generally, I just wanted to use it as an example, a very, very crude example of how you could look at it. But yeah, it's possible that PEG could actually be better. Can you apply the model to cryptos or other asset classes? You definitely can, but not in terms of like the exact replication. So instead of earnings, you could use different catalysts like large news, or you could use things like regulatory news. And news generally is what affects the new behavior and new prices. So you can more or less replicate it, but with a different context entirely. Is this method applicable to analyst upgrades or downgrades, as well as earnings announcements? I think this general method is applicable to almost any kind of strategy, and it's especially effective for mean reversion strategies. So it's definitely applicable, I would say. If you had a data of knowing exactly when analysts do upgrades or downgrades, then it's very possible that you could develop a strategy based off of the type of information, the magnitude, and what's going on there. What is the best time frame used for backtesting? There's really no best time frame. Backtesting is just something you do really at the end of it. So just full disclaimer, I did not go into backtesting, just plug in a bunch of numbers and just keep on trying stuff. Generally, it's really whatever time frame you're more interested in. I think the recent time frame is generally better for strategies going forward, but that's not necessarily true. It depends on the time frame of your strategy. Like if your strategy is, where you hold a stock for 2 years, well, then your backtesting time frame is completely different. Can you publish the code for your backtests? Yes, I'll publish the code for these backtests. I haven't actually made them readable, so I'll go and fix that first. Should you take volume into consideration? Volume could be something we take into consideration because volume is interesting in, it's also another proxy to understand the intention of the market, right? So when a stock has a lot of volume or very little volume, then we can interpret that the stock is very interesting or not interesting. Just to also clarify, all the strategies that I showed today, the universe is all using the QTE universe, and basically that means that it's generally tradable. So does this methodology work better for some sectors than others? That's entirely possible. I haven't really tried it with different sectors, so I don't have a good answer for that, but if you broke it down in different sectors, it might totally work. I think the only reason why it might not work is you'd have to be careful with the number of earnings that coincide. So sometimes not all earnings happen in the same week when you only look at one sector, right? But you could probably look at that and maybe stretch out the time frame a bit more. 12-year, can you go over why you look for low earnings surprise in the second model? Sure, 1 second. Let me kind of pull up my slides. Okay. So when you say, I'm assuming when it says low earnings surprise, it means we want the lowest amount of earnings surprise, right? And the main reason you want to look for the lowest earnings surprise is that it has the least attention. So when there's very little earnings surprise in a stock, let's say the same week, Netflix is a 10% earnings surprise versus another stock only has like a 0% earnings surprise, and everything is just, as expected. Well, the fact is the 0% earnings surprise still has a slight effect on the stock price. It's just that it's not being accounted for. So if there's even a bit of expectation towards that stock with very little earnings surprise, that misevaluation is not something people are looking for. People look for misevaluation for generally the large stocks and the big differences, big movements. So that's why I look at really the lowest absolute earnings surprise. So it says here 800 events per year seems quite small given the fact that every company publishes on a quarterly basis. Why is that? Yeah, sorry, I didn't specify, but this is only looking at the tradable universe, and that is possibly one of the reasons. So instead of looking at the whole universe, I've only used at the QT tradable universe, which includes about 3,000 stocks. Also, the filter that we add on here, it's about 30%. So essentially, instead of looking at the whole universe of it, I'm only looking at 30% of it. So that's probably why we see 800 events instead of like 3,000. You said go long on low PE, and by PE is very sectorial. How can that be applicable? Right, so that could be something that could be improved about the strategy, because PE is really dependent on the sectors depending on the sectors. So you can't just say go long or short PE. And that's something that could definitely be applicable. And the question is here, well, how is that applicable in this case? I think as a whole, when we don't assume any sector, and when you look at the whole market as a whole, it's still applicable just because of the number of different types of stocks you have on both ends.
Okay, so that is all the questions we've gotten so far. Like I said, if you do have a question or you think of something later and you want to ask Cheng, you can email it to us at events@quantopian.com and we'll get back to you as soon as we can. Our next webinar is this Thursday. It is an introduction to QGrid, which is a new program on our website. So you can register for that. And thank you, Cheng, for a great presentation.
Thank you.
All right, bye, everyone. Thank you for joining.